Welcome to the BF Anderson Technical Report for February the 14th. We start out with the NASDAQ. We always have felt that the NASDAQ is probably your more important index. It's got a lot of stocks in it, more growthy names. We're looking for growth, as you know, and as the economy is growing and GDP is growing, you're going to see it in the NASDAQ. Now, as you can see here, we made our low on the 24th. The moving averages were in a downtrend. They've now reversed. We've got a beginnings of an uptrend in the moving averages, where we've got a golden cross where the 25-day has crossed above the 50-day. The index itself is in an uptrend. Now, volume is somewhat anemic. We're not seeing any really exceptionally above average days to the upside, just something to be aware of. So it's been somewhat of a quiet week. If we move on to the weekly NASDAQ, important news there would be, last week we did have relatively good volume. Even the week before was even better. Again, we have more to go today and tomorrow. But here we have the 35-week moving average. This is a very critical area, very similar to the 200-day moving average. We have kissed that moving average, trying to bust through. In order to get a buy signal on this particular indicator, we would really need to see the NASDAQ cross above that 35-week moving average and stay there for 2 consecutive weeks. So that would be an important factor. Another thing that's really looking positive here is the advanced decline line. Now remember, advanced decline line is the net advancers on the New York Stock Exchange over decliners. So when you see the red bars, that means there's more decliners than advancers. Well, you can see for the last 3 days we've had some pretty healthy advancing above declining, and the most important thing about the advanced decline line is the trend of the line, which is up. So again, we're taking this a day at a time. You can't get too far out above your skis, because we just don't know whether or not the market's going to retest the December lows or not. Now, the high-low index, and remember, we are taking the number of new highs on the New York Stock Exchange divided by the number of new highs plus new lows. This is really getting up there, getting into kind of a frothy territory. It really did blast off from the 24th. I mean, it was basically straight up. So this is a very constructive pattern, but a little bit of an overbought pattern. I think I would be kind of careful here. Again, the number of new lows on the New York Stock Exchange, we're seeing anemic numbers of only 4 new lows yesterday. You can see that over, really since the beginning of the year, the number of new lows have completely dried up versus what happened last year, where they were just going through the roof. So we're seeing, again, more positives than negatives. We are leaning bullish is the basic bottom line. Now, I wanted to point out the Russell 2000 Small Cap Index. This is showing some real constructive pattern here. We've got a golden cross on the moving averages. And, if we can break out above this area here, this 1580 area, that would be a very strong sign. Now, again, going back to the long-term indicator, which is our monthly graph, this is the 10-month versus the 20-month. Again, we're seeing constructive activity here. The lower moving average is definitely in an uptrend. The upper moving average is now turning up. So we're seeing a very positive pattern here. So the long-term trend is still in place. We are in an uptrend. Now, on the put-call ratio, where we measure fear and greed, you can see we got into extreme fear back here at the end of last year. We pulled back, gotten kind of in a normalized area. I would call sentiment right now somewhat neutral. We're not really seeing any big dramatic negative thinking or positive thinking. It's somewhat neutral. Now, history says that the 100-day versus the 200-day death cross can lead to further declines. A decisive move above the 200-day and 200-day moving average from flat to uptrend would be positive. So what we need to see here is there's the 200-day. It's flat. We need to see it turn up. The 100-day is still in a downtrend. So, just to throw some water on the, some cold water on the market right now, the fact that we've gotten a death cross here on the 100 versus 200-day is not a good sign. So what we really need to see happen here is that the S&P 500 continue above the 200-day and the 200-day turn up into an uptrend. Now let's get into the top 5. I want to mention a book called Bad Blood. It's a story of a young lady by the name of Elizabeth Holmes. The book basically is about a massive fraud, and it was about a company called Theranos that developed or pretended to develop a technology where they could just take a drop of blood from your finger and do all type of testing and analysis. What the main point of me mentioning the book, though, is that there seems to be a tremendous amount of demand for technology to help with testing for diseases. So Exact Sciences here. This company has a technology that pretty much replaces colonoscopies. I had a talk with my doctor about it, and he was saying, that it's better for a younger person to go ahead and have a full-fledged colonoscopy. But when it comes to older patients where they're having to, put people under anesthesia, it might be better for them to use the Cologuard technology, which is where they actually defecate into a box and they can determine whether or not you are a high risk for colon cancers. But anyway, the stock has been holding up well. This group is looking interesting, meaning the medical technology group. There's several names we're looking at. Now, here's again the thing about the top five is that we're still seeing a dominance of software companies, what we would call cloud-based software companies. Now, here's a company called ServiceNow. They announced earnings. You can see the massive gap up on tremendous volume. Not only has the stock held the gap, but is breaking out again. So ServiceNow is definitely one to keep an eye on. Veeva Systems, another cloud-based software company, mainly for the healthcare industry, and you can see very strong uptrend. Here's a company called Workday. I was noticing the Pebble Beach golf tournament that Phil Mickelson was wearing a coat with Workday on it. They're one of his sponsors. You can see a pretty strong uptrend here. The moving averages are doing everything right. You've got a nice gap up here on the ServiceNow earnings announcement, actually, because these companies are kind of similar. Again, software. We're continuing to see software. Now, last but not least is a company called Xilinx. This is semiconductors. Again, technology is really dominating the list here, and semiconductors made by Xilinx are programmable semiconductors, which are very good for people that don't have custom semiconductors. It's kind of a step process that once you start to develop a technology, you start out with programmable semiconductors, and then if the technology really pans out and the market share is good, they start making custom. So this is a company that's involved in that type of business. I first found this company years ago when they were developing the chips that went into your keychain that opened and closed your car doors. I thought that was kind of amazing at the time. Now, where Xilinx is now, they're building chips, mainly communication chips, used in the 5G technology that has rolled out in China and South Korea. The reason the earnings were so good and the stock gapped up like this was that they were getting so much business from South Korea and China. So in conclusion, I would say that the market, we are leaning bullish. The market is looking much better. However, history does say that we do have the chance of a retest of the December lows. We'll just have to take it a day at a time. Thank you very much.